Hey everyone, welcome back to Corporate Decoder, the place where we dissect the documents that Wall Street hopes you won't read too closely. Today we're diving into a company that's facing a bit of a delisting dilemma. Think of it like getting kicked out of the cool kids club, but in the stock market. We are looking at a Form 8K filed by Valuence Merger Corp. On March 7, 2025. An 8K is a current report company's file to announce major events, and in this case, it's a notification that they might be getting kicked off the Nasdaq Stock Exchange, which is like the New York Stock Exchange but for tech and growth companies. So the clock started ticking on March 4, 2025 when they received this notice. Here's the core issue. Valuence Merger Corp. Received a warning from Nasdaq. Nasdaq sent them a written notice. This notice said that the company's stock might be removed. It is like getting a letter saying you are in trouble. This is because they didn't complete a business combination by February 28, 2025. Nasdaq has a rule IM 5101-2 that says a company like Valuence needs to make a deal within a certain time. Valuence didn't meet that deadline. Basically, these special purpose acquisition companies or SPACs have a time limit to find a company to merge with, and Valuence Merger Corp. Ran out of time. It had 36 months from the IPO, but they could not do it. So starting March 11, 2025, trading of their shares, units, and warrants will be stopped or suspended on Nasdaq. It's like the stock is grounded. Then Nasdaq will file a Form 25, which is the official paperwork to remove the company's stock from being listed on Nasdaq. After getting kicked off Nasdaq, the company expects its stock to be traded on something called the Pink Open Market or OTC market. Think of the Pink Open Market as a less regulated, smaller stock market. It's where companies go when they can't meet the requirements of bigger exchanges like Nasdaq or the New York Stock Exchange. Their stock will trade under the same symbols VMCA, VMCAU, and VMCAW. Now here's the catch. The company says it still wants to find a business to merge with. It also wants to get its stock listed back on Nasdaq or maybe another big stock exchange, but there's no guarantee that will happen. It is risky and is like saying, we hope to do it. Looking at this situation overall, there are several factors to consider. Valuence Merger Corp. Aimed to complete a merger within a specific timeframe but failed to do so. This failure led to a notice of delisting from Nasdaq, a major stock exchange. While the company expresses its intention to pursue a business combination and relist its stock, the outcome is uncertain. One of the strengths is that the company is still trying to find a business to merge with. They haven't given up, but one of the weaknesses is that there's no guarantee they'll succeed. The stock being traded on the OTC market, also known as the pink market, is less regulated and may not be as attractive to investors. There are risks involved in investing in a company that's been delisted. The stock price could go down and it might be harder to buy or sell the stock. However, if the company does manage to find a good merger and get relisted, the stock price could go up significantly. In conclusion, Valuence Merger Corp. Is in a tough spot. They're facing delisting from Nasdaq, but they're still trying to make a deal happen. Investors should be careful and consider the risks before investing in this company. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate filings.